We're going to get our question from Ross. My parents are retiring in a few years, and they plan on retiring with a 90-10 split of stocks and cash, with the cash covering about 2 years of expenses. Should I try harder to get my parents to change their allocations? Is the 2 years of cash enough to meaningfully offset stock market drops enough relative to a traditional split?
Well, Ross, I'll start with the guidance we provide in Rule Your Retirement, and that is for the retiree portfolio, it's that classic 60% stocks, 40% bond split. We also talk about an income cushion of 3 to 5 years of portfolio provided income outside of the stock market in cash, short-term bonds, because historically bear markets last about 3 years from peak to trough to peak again, though there are many that last longer. So 3 to 5 years out of the stock market, I think, is a start. So yes, your gut reaction that maybe your parents are being too aggressive makes sense to some degree. That said, there are situations when it's okay to be more aggressive with your portfolio. Maybe they have a pension. Maybe they have business income. Maybe they have rental property. So they have other sources of income that they can rely on that allow them to be a little bit more aggressive in their portfolios. If you look at the safe withdrawal rate research, definitely indicates that the optimal stock allocation is between 50 and 70%, maybe 75% is high. But it's actually not quite as dire if you go higher than that, and we'll talk about why, and I'll give you an example. So in 2013, Warren Buffett in his annual letter said that he's directed in his will that when he passes on, his wife's portfolio will be 90% S&P 500, 10% short-term bonds. Now, on one hand, of course, whatever she's going to inherit, he didn't say how much, but it's probably in the tens of millions.
I would think that's fair.
Enough,
right.
Yeah.
So when you have that much money, when the market drops 50%, you're probably okay. But in 2015, an economist, Javier Estrada, took a look at this and said, okay, this is Buffett's advice. How would that have worked out over the 30-year period starting in 1900, so every 30-year period, all the way up through the period ending 2014, 90% stocks, 10% bonds, 4% withdrawal rate. The withdrawals are coming proportionately from the stocks and the bonds, 90%, 10%, and then rebalanced annually. And how many 30-year periods did that person run out of money? Only 2.3% of the time.
Nice.
So it's actually not quite as risky as you might think. That said, in 10% of the time, this retiree was getting close to like having only 20% left of their portfolio. So it's still pretty risky, but he came up with 2 other tweaks to it. One was when you take out the withdrawal, anytime the stock market is up, you take it from stocks. If it's down, you take it from the bonds. And then the other tweak was anytime stocks whatever it was outperforming, you take the money from. So if stocks did better than bonds, you take it from stocks. If bonds did better, you take it from bonds. What did that do? Actually increase the upside potential and downside protection. So it's even safer. So the bottom line is, while I think that for most retirees, having 90% in the stock market is too aggressive, and I would just talk to your parents and say, what's going to happen if we have another decade like we had the first decade of this century, where we had 2 significant bear markets, and over the whole 10-year period, stocks lost money? Do they have a backup plan? Talk to them about that. But as long as the future looks vaguely like the past, it's actually not as risky as we might think.
May I ask a question?
Please do.
I know I'm the new guy. Right? Is that allowed?
Sure.
Yes, I'll allow it.
Is it fair to say that once you reach a certain age, let's say you're in your 90s, that you can start to think of it no longer as your portfolio, but the portfolio of your heirs? And if your heirs are 40s or 50 years old, then 90% stocks for those folks may be perfectly appropriate?
Yes, absolutely. And there's some research that came out maybe 4 or 5 years ago by Wade Pfau, who's been on our show, and Michael Kitces. And they actually found that it actually makes sense to reduce your stock allocation right around retirement, but as you get older, to increase your stock allocation, largely because of that. In the end, most of the money that you have is going to be left to your heirs.